A motorcycle sitting on a dealership floor looks like inventory. On a balance sheet, it is capital. And once that capital is financed, time is no longer neutral. That is where the real problem begins. Most discussions around dealership inventory stay at the surface level. Units in stock, days supply, pricing pressure, incentives, sell-through. But underneath those metrics is a deeper structural reality. When inventory stops turning, the issue is not simply that a bike remains unsold. The issue is that capital has stopped moving while carrying cost continues to accumulate. In a franchise distribution system, that burden sits overwhelmingly at the dealer level. The manufacturer plans production. The network receives allocation. The dealer carries the exposure. This is one of the central tensions in the powersports business, and one of the least honestly discussed. Because full inventory can look healthy. It can suggest scale, selection, representation, momentum. But the visual logic of inventory and the financial logic of inventory are not the same. A full floor does not necessarily indicate strength. Sometimes it indicates trapped capital, deteriorating flexibility, and a widening gap between production logic and retail reality. This episode is about carrying cost, cost of money, inventory turns, and the downstream burden created when units arrive faster than they are absorbed. Not as a complaint, as a structural fact. Inventory is not merchandise. It is capital deployment. The first mistake the industry often makes is speaking about inventory as though it were simply product. Capacity that could otherwise support used acquisition, service growth, staffing, marketing, facility investment, or simply liquidity. This is why aging inventory is never just an inventory issue. It is a capital allocation issue. And as soon as the business starts carrying more age than it can comfortably absorb, management optionality begins to narrow. That narrowing is where stress enters the system. Not always visible, not always immediate. Operationally, inventory is capital deployment. Every unit on the floor represents committed capital, whether directly funded or financed. That capital has an expected purpose. It is supposed to move into retail, convert back into cash, and be redeployed. When that cycle works, inventory is productive. When that cycle slows, inventory becomes a drag on capital efficiency. That distinction matters, because in motorcycle retail, the unit is not just occupying floor space, it is occupying financial capacity. Once financed, time has a cost. The moment inventory is financed, time starts affecting economics, whether the unit sells or not. That is the point too many operators delay confronting. A bike that sits for 30 days may feel well positioned. At 60 days, perhaps still manageable. At 90, concerns begin to rise. At 120 and beyond, the unit is no longer simply inventory. It is now a financial decision that has been left unresolved, and that cost is not theoretical. Take a simplified example. Landed cost of a bike, $20,000. Cost of money, 8% annually. Annual carry cost, $1,600. Monthly carry, approximately $135. Now extend that over time. At 90 days, the carry cost is roughly $400. At 180 days, $800. At 270 days, $1,200. At 365 days, roughly $1,600 carry cost. Again, that is before markdown pressure, before model year aging, before weakened desirability, and before the opportunity cost of what else that capital could have been doing. Now multiply it. 150 units at an average landed cost of $20,000 is $3 million of inventory exposure. At 8%, that is $240,000 annually in cost of money. Over $20,000 per month. That is not an accounting footnote. That is gross margin under pressure before a single additional strategic mistake is made. This is where the conversation becomes more serious than simple aging reports, because once time begins eroding economics, management is no longer just deciding how to sell a bike. Management is deciding how long to let capital underperform. Inventory turns are a capital efficiency metric. Inventory turns are often discussed as an operating KPI. That is true, but incomplete. Inventory turns are really a measure of capital efficiency. They show how long cash remains trapped before it becomes useful again. Fast turns preserve optionality. Slow turns reduce it. That matters because a dealership with healthy turns can absorb shocks more effectively. It can respond to local demand more intelligently. It can refresh mix. It can act on used opportunities. It can support service growth. It can market with confidence. A dealership with poor turns becomes progressively less flexible. Not because management suddenly became weak, but because the business is losing speed. And in retail, losing speed usually means losing options. This is why inventory turn should never be treated as a secondary metric or a back office concern. It is central to commercial health. A unit that turns quickly protects margin from time. A unit that lingers places margin into direct competition with time. That is a very different contest. And time usually wins if the store hesitates too long. The downstream burden of allocation. This is where the issue moves beyond store execution and into network structure. Manufacturers plan production around capacity, product strategy, market priorities, and throughput objectives. That is understandable. Factories cannot be managed on improvisation. Networks require representation. Model mix needs to be pushed into market. But once inventory moves into dealer stock, the burden changes form. The OEM carries production logic. The dealer carries retail absorption risk, and those two logics do not always align neatly. A unit that fits a production schedule, a planning target, or a network objective may not fit local demand conditions, seasonality, store liquidity, or actual retail appetite at that moment. But when the unit arrives, the balance sheet consequence is immediate. The dealer is now funding the gap between shipment and sell-through. That is the downstream burden. Not because the manufacturer is irrational, not because the dealer is necessarily mismanaging, but because the structure itself transfers time-based retail risk into the dealer network. This is one of the defining tensions of franchise powersports distribution. Throughput pressure upstream, absorption pressure downstream, and the dealer sits where those two pressures meet. That is why over-allocation is so damaging when retail reality softens. Not only does it add units, it consumes dealer flexibility. And once flexibility is consumed, even good operators start spending more time defending past decisions than shaping future ones. Aging inventory distorts decision making. Aging inventory does not just weaken the balance sheet, it distorts management behavior. That is one of the most important consequences and one of the least measured. Once too many units age beyond comfort, decision-making changes. Stores become slower to acknowledge market signals. Operators hold for a gross target that may no longer be economically real. Managers rationalize patience that is actually delay. Teams become emotionally attached to the idea of what the unit should be worth rather than what the market will now clear. That is how age turns from a metric into a strategic distortion. And it happens gradually. No single unit breaks the system. But enough aging inventory changes the tone of the store. It tightens pricing conversations. It encourages defensive forecasting. It makes acquisition more cautious in some places and more desperate in others. It reduces confidence, and confidence matters in a retail network. Because once operators start feeling that the inventory is working against them rather than for them, the business becomes more reactive. The store still functions, it still opens, it still retails units. But management is increasingly acting under constraint. And that is where performance starts to erode even before the P&L fully exposes the problem. The cost is not limited to the motorcycle department. Too often, this subject is isolated inside motorcycle inventory management. In reality, the effects spill across the entire dealership. When too much capital is trapped in slow-moving inventory, the pressure does not stay neatly inside new unit retail. It affects what the business can do elsewhere. Used inventory strategy becomes weaker because cash is less available. Service expansion may be delayed. Hiring gets pushed. Marketing becomes more hesitant. Reconditioning cadence slows. Discretion disappears. And once discretion disappears, the dealership becomes less able to adapt. This matters because strong stores do not win simply by stocking product. They win by allocating capital intelligently across the whole operation. The more inventory age consumes that flexibility, the more the rest of the business operates under a silent tax, not a tax imposed by regulation, a tax imposed by stalled capital. This is what aged inventory becomes over time. A silent internal tax on decision-making freedom. Gross margin on paper is not the same as economic margin. This is where many inventory conversations become dangerously misleading. A store may look at a unit and say there's still margin in it, and on paper that may be true. But paper margin and economic margin are not always the same. If the unit has absorbed months of carry, delayed management attention, and lost time value while consuming capital that could have performed elsewhere, the true economic margin is already lower than the ticket suggests. Sometimes materially lower. This is the point at which stores begin telling themselves a comforting fiction, that holding the line on price protects gross. In some cases it does. In others, it simply protects the memory of gross while actual economics deteriorate. The issue is not whether margin exists in theory. The issue is whether the margin remains attractive over time. That is a harder question. It's also the more honest one. Strong operators ask that question early. Weaker operators ask it only after the unit has already become a burden. This is why discipline matters more than optics. A full floor can impress customers. A broad model mix can satisfy network expectations. A stock showroom can create the appearance of strength. But a strong dealership is not defined by how full it looks. It's defined by how intelligently capital moves. That means discipline matters more than optics. Discipline in ordering. Discipline in accepting mix. Discipline in confronting age. Discipline in distinguishing real demand from internal optimism. Discipline in deciding when a unit is no longer serving the business at the level expected. This does not mean panic discounting. It does not mean abandoning margin logic. And it does not mean reducing the issue to blame. It means understanding that time changes economics, whether management acknowledges it or not. The best operators are not simply good at selling inventory. They are good at recognizing when inventory has stopped serving its intended function, and then acting before the damage compounds. Why this becomes a network issue. At a certain scale, this is no longer just a store-level problem. It becomes a network issue. Because when aging inventory builds across a dealer body, consequences spread. Pricing discipline weakens. Discount behavior becomes more visible. Gross compresses. Dealer confidence drops. Future ordering behavior changes. Relationships between field teams and operators become more strained. And the brand itself can start feeling the downstream effects of inventory that remains physically present but economically heavy. That is why mature markets eventually build stronger recovery mechanisms. Auctions, wholesale channels, alternative distribution pathways. Systems that allow inventory to move without every exit becoming a public markdown event. Because inventory that cannot move quickly and quietly will eventually move noisily. And noisy movement damages more than margin. It damages confidence. This is one of the reasons the powersport industry still has structural work to do. The network remains too exposed to inventory aging as a dealer-held burden rather than a system-managed reality. A motorcycle on a dealership floor is not just a unit. It is a capital decision waiting to prove whether it was right. If it turns efficiently, it supports the business. If it lingers, it begins to consume the flexibility the business needs to stay healthy. That is why carrying cost matters. That is why the cost of money matters. That is why inventory turns matter. And that's why allocation without full respect for retail absorption can become so destabilizing over time. Because the real damage of aging inventory is not simply that a bike remains unsold. The real damage is that capital stops moving while pressure continues to build. And once that happens, the issue is no longer cosmetic. It is structural. If you work inside the powersports business and want clearer analysis of the forces shaping dealer economics, market structure, and network performance, subscribe to PSX, the Standard.